Does Australia have an exit tax? The deemed disposal. As we know, the Australian tax system is intricate. However, within those intricacies, there may in fact be policies that favour you. That is my sentiment about the deemed disposal rules in Australia, aka the exit tax. So what is the deemed disposal? At the ceasing of your Australian tax residency, you have the opportunity to elect whether or not you want to access the deemed disposal, aka in tax talk, capital gains tax event I1. And the way the CGT I1 event is calculated is it takes the cost base of the asset as you regularly calculate a CGT event. And in this case, you use the market value as at the date of ceasing your residency to determine the capital gains in that event. So let's give you an example to simplify things. We have Jeremy here. Jeremy purchased one Bitcoin at $20,000 in 2018. Jeremy's plan is to hold on to that Bitcoin for an extended period of time. He's got no plans on selling that. As the words are, hodl, hold on for dear life. If he does not partake in the deemed disposal, then he needs to pay tax on the disposal of that Bitcoin when he eventually sells it. This has its own complications, which we'll touch on later on. If he does take the deemed disposal, let's say, for example, the market value as at the ceasing of his Australian tax residency is $30,000. That's an effective gain of $10,000. If he's held it for more than 12 months, it's a 50% discount on that gain. And then that $5,000 taxable gain goes on to his taxable income, where he's taxed at marginal tax rates. However, the devil is in the detail here. And this is why I always say how important it is for you to consider your own personal, unique circumstances. Let's say Jeremy plans to return back to Australia in, say, 10 years. Now, we don't know what the price of the asset will be in 10 years, but I'm confident that in 10 years, the price of Bitcoin will be more than $30,000. So when Jeremy repatriates back to Australia and recommences his Australian tax residency, he's deemed to have acquired that Bitcoin as at the market value, as at the day he commenced his residency, which could be effectively anything. It could be to the moon. Who knows? Let's say, for example, it's $100,000. If Jeremy did not elect to take up the deemed disposal, then the cost of his asset will still continue to be the cost he paid for it at $20,000. So any future gains will be taxed at that. However, if he does partake in the deemed disposal, the recommencement of his Australian tax residency, the asset is now worth $100,000. So if he does eventually sell it or dispose of it when he passes, or to give it to his children, he's got a higher cost base, and the gain between the period he was not an Australian tax resident is not technically taxable in Australia, which may in fact save him a significant amount of money. I'm pro the deemed disposal if all the conditions are right for it. Let's talk about some pros and some cons of the deemed disposal to give you a bit more information. Let's start off with the cons. And look, this is the biggest con of all, and I completely understand where it comes from. It is having to come up with the money to pay the tax without actually disposing of the assets. And I understand if this is not possible to do because you might have a significant asset and cash flow might be tight. So in this case, there may be ways to mitigate that, whether it's refinancing, whether it's putting a payment plan in place, whether it's disposing part of the asset. Again, you need to always consider your circumstances. Another couple of the cons is that if you do dispose of your asset when you're a non-resident, you need to pay tax at non-resident rates. You also are unable to access the 50% capital gains tax discount as a non-resident if disposed. And the last con is, as I mentioned with Jeremy, you're not able to reacquire that asset as at its new market value at the recommencement of Australian tax residency. Some of the pros are you do get to access the 50% capital gains tax discount, you get taxed to your resident rates, and you have the option of, or you have the ability to recommence the market value or the cost, which as at the market value of your recommencement of your Australian tax residency. Please note that once this choice has been made, it applies to all capital gains tax assets that are non-taxable Australian property. Non-taxable Australian property is effectively any asset that is not Australian property. We will put an ATO link down because there's a bit more involved, but the majority of assets that aren't Australian property. And look, as always, if you're going to partake in the deemed disposal, I highly recommend seeking professional help. A professional will be able to assist you in ensuring that you are able to correctly ascertain what needs your obligations, but also potentially produce some financial modeling in place to view the viability of the options involved. So please reach out. More than happy to help. We've assisted many clients with deemed disposals. Whether or not we've actually gone through with them, providing advice on them is vital when it comes to residency and ceasing or recommencing your Australian tax residency. If you enjoyed this video, please like and please subscribe. We love hearing your comments, so chuck some comments below. If you have any questions, do not hesitate to reach out. We'll provide our contact details at the bottom. So to summarize, and to answer the question, yes, Australia does have an exit tax, but you are not obliged to pay upfront. Thank you so much and have a lovely day.